Right now, most people have money sitting in a savings account waiting for the right moment to invest. 50,000 euros sitting in cash for 1 year in 2023 meant approximately 11,000 euros in market gains never made. Not lost, never made. That is the cost of waiting. The lump sum versus DCA debate is one of the most discussed in investing, and almost every explanation gets it wrong because it answers the wrong question. The real enemy is not the strategy. It is the delay. This is what NTM told us, the technical layer behind the philosophy. In the next 8 minutes, what the math says about lump sum investing, what the psychology says about DCA, and the one thing that beats both, which almost nobody talks about. Your brain is wired to avoid regret more than it is wired to seek reward. This is called loss aversion, and it explains why most people choose DCA even when the math favors lump sum. Imagine investing 50,000 euros in a single day. The next week, the market drops 10%. You have lost 5,000 euros in 7 days. Your brain does not process this as market volatility. It processes it as a mistake you made. Now imagine investing the same 50,000 across 12 monthly payments. The market drops the same 10% in week 1. You have lost only 4,000 euros on the portion invested. The pain is smaller because the decision is spread out. Same market, same ultimate outcome. Different pain. The brain prefers DCA not because it is mathematically superior, but because it produces less regret when things go wrong immediately after investing. DCA is not an investment strategy. It is a regret management strategy. Chapter 1. What the math says. In 2012, Vanguard published one of the most cited studies in investment strategy, Invest Now or Temporarily Hold Your Cash. The research covered US, UK, and Australian markets across multiple decades. The finding was unambiguous. Lump sum investing outperforms DCA approximately 68% of the time. On average, lump sum beats DCA by 2.3 percentage points over a 12-month period. The reason is straightforward. Markets rise more often than they fall. On average, equities trend upward over time. Money invested earlier has more time in a rising market. A strategy that holds cash and invests gradually keeps money out of a rising market longer and pays the price for that. The Vanguard study's conclusion, stated directly in the research, the longer the investment horizon, the more consistently lump sum investing outperforms DCA. Mike Petry watched a client at one of his Big Four engagements sit in cash for 14 months waiting for the right moment to invest. The market ran 22% without him. By the time he invested, he needed the market to do significantly more just to reach where he would have been. The right moment never came. Because it never does. The math is not subtle. Lump sum wins. Most of the time. Chapter 2. What the psychology says. The math favors lump sum. The psychology complicates it. In 2021, Vanguard updated their research with an important addition. They acknowledged that for many investors, DCA produces better real-world outcomes, not because of the mathematics, but because of the behavior it enables. An investor who invests a lump sum and then panic sells during a market crash earns worse returns than an investor who uses DCA and stays invested through the entire journey. The psychological comfort of DCA, smaller increments, less regret exposure, keeps investors in the market when markets are volatile. According to J.P. Morgan Asset Management Research, missing just the 10 best trading days in the S&P 500 over a 20-year period reduces returns by more than 50%. That is half your retirement, gone, for one panicked click. Most of those 10 best days occur within weeks of the 10 worst days. An investor who sells during the crash, the investor whose regret overwhelmed their strategy, misses the recovery that follows. DCA does not win mathematically. It wins behaviorally. For many investors, that is the more important victory. If the math versus psychology split is landing, hit like. It helps more investors find exactly this kind of breakdown. Chapter 3. The real enemy, delay. Here is what the lump sum versus DCA debate consistently misses. The comparison assumes the investor actually invests, either all at once or gradually. The data on what investors actually do tells a different story. According to Charles Schwab research, the average investor who receives a lump sum, an inheritance, a work bonus, a redundancy payment, delays investing it for an average of 11 months, not because they chose DCA, because they froze, waiting for the right moment, waiting for the market to dip, waiting to feel more confident. That 11-month delay in a typical market environment costs more than the entire lump sum versus DCA difference measured in the Vanguard study. The lump sum versus DCA debate matters, but it matters a fraction as much as the question, are you investing at all, on any schedule, consistently? Perfect timing versus consistent action. Consistent action wins every time. Mike Petry invests monthly on NobodyToldMike, not because DCA mathematically beats lump sum, but because a consistent monthly schedule eliminates the delay entirely. The decision is made once. The automation does the rest. Chapter 4. What this means in practice, 3 scenarios, and what to do in each. Scenario 1. You have a lump sum and are a confident investor. The math supports investing it all immediately. Markets rise more than they fall. Time in market beats timing the market. The regret risk is manageable if you understand it is coming and commit to staying invested regardless. Scenario 2. You have a lump sum and the idea of immediate investment causes anxiety. Split it into 3 to 6 monthly investments. You will likely underperform the pure lump sum outcome, but you will stay invested. And staying invested matters more than the strategy used to enter. Scenario 3. You receive income monthly, salary, freelance, any regular payment. DCA is not a strategic choice. It is the only available option. Invest a fixed percentage of income every month automatically into the same ETF. The automation removes the decision entirely. This is Mike Petry's approach, covered in depth on Nobody Told Mike. Lump sum versus DCA is a real debate with a real answer. The math favors lump sum 68% of the time. The psychology favors DCA for investors who need consistency over optimization. And both are defeated by delay. The investor who waits 11 months for the perfect moment and never finds it. Mike Petry invests monthly. The automation is the strategy, not because the math is perfect, because it removes the decision, eliminates the delay, and keeps money in the market compounding, which is the only mechanism that actually builds wealth over time. That is what Mike Petry calls modern financial philosophy. Not the perfect strategy, the consistent one, applied indefinitely, the reframe worth keeping. The best investment strategy is the one you do not have to think about every month. Write that down, because the investor who automates a good enough strategy beats the investor who analyzes the perfect one indefinitely. Here's the question for the comments. Are you lump sum, DCA, or still waiting for the right moment? Be honest. And if it is the third one, this episode was for you. If this breakdown clicked for you, subscribe here for more NTM explainers. And watch Mike explain his full investment philosophy. Nobody Told Mike, link below.